Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, October 3rd. Tensions in the Middle East mount. The ADP report from the US came in higher than expected by analysts. The new Japanese PM says that the Japanese economy is not ready for further interest rate hikes, and investors around the world are holding their breath before tomorrow's official US jobs data. So the geopolitical situation in the Middle East gets tenser, and the Fed does get a bit worried this week with the side of better than expected jolts and ADP report from the US that were announced earlier this week. Now, yesterday's ADP report from the US wasn't very strong per se, but showed that the US economy added around 143,000 new private jobs last month, and that's comfortably higher than the 124,000 penciled in by analysts, and last month's figure saw a little upward revision as well to just above 100,000 job additions. So we are not near 200 to 300,000 job additions per month of the post-pandemic months. We are quite far from that, but we are not seeing the kind of numbers that would keep the expectation of another jumbo rate cut from the Fed in November either. So, the US 2-year yield is pushing gently above the 3.60% level these days, having bottomed near the 3.5% level last week when the 50 basis point cut expectations for the FOMC's November meeting have surfaced, remember, and the US 10-year yield recovered to 3.80% level, and the US dollar broke above its negative trend top that was building since summer this year and is now preparing to test the 50-day moving average resistance to the upside. So all that looks reasonable to me. Now the last test for the US dollar bulls is tomorrow's official jobs data from the US. If the data continues to show that the US jobs market is slowing but not collapsing, we shall then see the US dollar recover further against its major peers. Now, so far, the stronger US dollar, combined with a slide in the euro area inflation below the European Central Bank's 2% policy target, justifies a further sell-off in the euro dollar. So the pair took out the 50-day moving average support and is now preparing to test the next and the important psychological support of 110 mark. Now, below that level, at 109.80 stands the major 38.2% Fibonacci retracement on June to September rebound, and that should in theory distinguish between the actual positive trend building since summer in the euro dollar and, well, in medium term, bearish reversal. And of course, we can't disregard the sharp Japanese yen sell-off that we saw yesterday. That's also giving an additional support to the US dollar today following the new Japanese PM, Mr. Ishiba's comments that, well, the Japanese economy is not ready yet for further interest rate hikes. Now, the man said that he told the governor that his hope was that the economy will make progress in a sustainable manner toward the end of deflation with monetary easing trend in place. That's a big hope. And that's a person that was supposed to be in favor of normalizing the rate. So you imagine the yen bull's deception yesterday. The dollar yen was sent immediately above the 146 level. And well, we can all forget a sustainable fall to and below the 140 level, I guess. Now, I think that there is a greater chance that we see the pair, the dollar yen, return and stabilize near the 148 to 150 level range. So that's it for the major FX moves. I'm coming back to the US jobs data because that's like the major topic of the week. Now, a better than expected set of US jobs data this week is obviously positive for the US dollar bulls. It is negative for the US Treasuries, positive for the US Treasury yields, but it is not outright positive or negative for sentiment in the stock markets. Because yes, the Fed cuts are great, obviously, for stock valuations, and the 50 basis point cut from the Fed has provided a lot of joy to stock investors. But a collapsing jobs market in the US is fundamentally bad news for the economy and for business. So the impact of a possibly stronger than expected jobs data on Friday from the US is quite difficult to assess, really. In one hand, a good set of data would confirm that the US economy is doing relatively well enough to keep the S&P 500's profit expectations strong enough and give a further support to stock valuations near their all-time high levels. On the other hand, a too strong set of data would crash the expectations of further and aggressive rate cuts from the Federal Reserve this year, and that is just mathematically unfavorable for the stock valuations. So investors' opinion diverge these days. Many, or those that we hear a lot in the news, will think that the 6,000 level in the S&P 500 is not only within reach, but is also a very easy target to reach for the remainder of this year. While a few others, like Apollo's CEO, for example, think that the Federal Reserve has no reason whatsoever to keep cutting its interest rates and that this aggressive U-turn could backfire. After all, the US ports went on a strike this week, remember? The oil bulls give signs of life as a result of widening conflict in the Middle East between Israel and Iran, and the Fed, may have simply declared victory on inflation earlier than ideal, and possibly louder than reasonable. And speaking of the Middle East conflict, oil prices rose yesterday as Israel promised to retaliate against Iran, and the G7 leaders are now preparing to impose fresh sanctions on Iran. But again, the top side in crude oil remained capped right near the $72.85 per barrel level for the US crude, which is the major Fibonacci retracement on July to September retreat in these prices, and that should, in theory, distinguish between the actual bearish trend in US crude and a medium-term bullish reversal. Now, I know I insist, but I find the US crude's inability to clear this technical Fibonacci resistance quite interesting and quite informing indeed, because it tells me that the geopolitical tensions of the Middle East do attract tactical longs, but the conviction for reversing a medium-term trend is still not there. I mean, look, we saw yesterday's gains in crude oil rapidly given back after the EIA data showed a 3.9 million barrel build in oil inventories in the US last week. So you can see that the geopolitical tensions are still, somehow challenged by the macroeconomic trends. Now, note that some bullish voices are emerging these days, putting the $100 per barrel target back on the table for crude oil, but I believe that we will hardly see the barrel of US crude, for example, go past the $88 to $90 per barrel range in case of very, very badly deteriorating situation in the Middle East. Because first, OPEC Plus is preparing to call the end of its production restrictions by the end of this year, and Saudi Arabia is also moving toward a strategy where it will try to increase its market share rather than continue to support the oil prices for everybody. And second, around half to two-thirds of the Iranian oil goes mainly to China, which is not concerned by the sanctions that are being prepared by the G7 leaders. Now, the only thing that could really extend the top side in crude oil is if the US-backed Israel attacked the Iranian oil facilities. That's, to me, the biggest risk to the global oil supply and, the only scenario which would eventually justify a rise in crude oil prices to levels like $100 per barrel level or more. But if that's the case, imagine what will happen to the Federal Reserve and to the other major central banks' inflation expectations and their loosening monetary policies. It would, simply stop and maybe even reverse them, which in return, would boost the global recession expectations and limit crude oil's upside potential. So what I'm trying to say here is that, the geopolitical tensions could actually be interesting for tactical opportunities for oil bulls, but the medium-term picture across the world for crude oil remains comfortably bearish still. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.